A year after the oil rout began, we're in the middle of third quarter earnings season here in the US, and Exxon and Chevron today have reported results for the third quarter. With me to discuss what we've learned from their results, Ed Crooks, US Energy and Industry Editor. Ed, what did we learn from the results today of Exxon and Chevron? What are the key takeaways?
Well, as you're saying, the results are obviously reflecting the crash in oil and gas prices, and so big drop in earnings, 47% for Exxon, 63% for Chevron. So they are certainly suffering. I guess one thing you could say we've learned, though, is that it's worth being big and it's worth being integrated. These companies are still kind of soup to nuts, full service oil companies, right. From drilling the wells, finding the oil, drilling the wells, getting out of the ground, refining it, right the way down to selling it. And what's happened as the price of oil has fallen is that obviously producing oil has become a terrible business, but selling refined fuels has got much better. Refining margins have expanded significantly, and so these companies for the moment are really being saved by their downstream refining and marketing businesses, which have done much better. We've had big increases in those divisions' profits, both from Exxon and from Chevron. Actually, the profits at Exxon's downstream business have doubled over the past year, up from $1 billion in the third quarter of 2014 to $2 billion in the third quarter of this year.
And that's interesting because years ago, investors worried about the integrated nature and whether it was great to be in the refining business or not. So that's flipped a little bit.
Exactly. And you could still say there isn't necessarily a great deal of synergy in a kind of a business sense between being an oil producer and being a refiner. And there are plenty of companies that work perfectly well as only refiners or as only producers. But what does happen then is you get this smoothing effect on your earnings as in a purely financial sense. It makes the company more stable, it makes the earnings more stable. And again, of course, if you compare with ConocoPhillips, it's pretty instructive. So
Conoco having split off their
exactly. That was an integrated company. It was the kind of the third biggest integrated company in the US. Split off its refining and chemicals business into a company called Phillips 66, which is still going from strength to strength, whereas ConocoPhillips, which is only now purely an upstream company, reported a big loss, about $1 billion loss for the third quarter.
Right. And so we think about the pure play explorers and producers, maybe not Conoco, which is a very big one, but some of these mid-sized ones that have sprouted up over the last several years, part of the shale boom revolution. What have we learned in the last few weeks about these smaller companies and what their prospects are in a world of truly depressed oil prices?
Probably won't see quite the same level of pain in the smaller exploration and production companies, but still it's going to be a terrible set of results for them. They will all have lost money, or certainly almost all have lost money, and clearly the focus with those companies is going to be on their financial stability and their financial strength, and questions about if cash is still flowing out of those businesses at quite a high rate, which it will be, then how do they sustain that? Will the capital markets and the banks be prepared to keep financing them for as long as it takes, I guess, for the oil price to recover, which is the point when things might start looking up for them. And so that's going to be something we're going to see a great deal of focus on when those companies report over the next couple of weeks.
Right. And so final question, capital allocation for the likes of Exxon and Chevron. What are investors worried about? They're worried about dividends. How safe are those? And do you think these big producers will try to pick up some of these smaller troubled ones in acquisitions?
I think certainly the dividends are pretty safe. I think things have to get significantly worse than they are now, really, for any of these big companies to want to cut their dividends. That would be a huge step. And certainly we've heard quite a few CEOs of the big companies, big European companies, BP and Shell as well, talking about how important the dividends are, how much they know that investors rely on those dividends. And so it would be a huge shock, probably a career-ending shock for the CEO if they did have to cut the dividend. So I think certainly they're going to be doing whatever they can to avoid that. And they do still have enormous financial strength, and they have enormous capacity to borrow more money, and that's what they're going to be doing. That said, even for a company like Chevron, so a very big, stable company, if you look at their kind of cash flows for the first 9 months of this year, they had cash from their operations, cash coming in, essentially about $15 billion. They had cash going out in capital spending of $25 billion, so they're already kind of $10 billion in the hole. and then they paid out dividends of $6 billion on top of that. That's clearly not a sustainable position. They can cover some of it with asset sales, but they're going to have to get back to some kind of cash balance.
So they're probably not a likely acquirer of big.
So exactly. I think certainly you would say for cash and for debt, they're not likely acquirers. They might still use stock, and certainly that's a possibility, and there's a lot of kind of talk about that, that given, as I was saying, we were talking about the financial pressures on those smaller companies. If they see really distressed companies, really distressed assets perhaps as well, good assets owned by bad companies with weak balance sheets, then there could well be some deals. And actually, I mean, there are some people who think it's a bit surprising that we haven't seen more deals than we have. Actually, that activity has been fairly quiet so far. And I guess you could say maybe the big companies are concentrating more on keeping their costs down, improving their cash flows, they're making sure they can cover those dividends. So, bottom line on that, I think there will be a bit more M&A activity, but certainly I don't think we can expect the huge deals that we saw at the end of the 90s and that last period of consolidation in the industry where we had that again. Low oil prices drove a lot of consolidation in the industry. I don't think we're going to see that again.
All right, we'll be watching. Thank you, Ed Crooks.